So I want you to imagine that you're a rating agency and you're trying to figure out what the appropriate rating is for these bonds. How would you rate them? Well, it depends. What's their default and what's the historical relationship between defaults and ratings. So let me show you what the historical relationship. These are data taken from Moody's for the actual historical realized default rates from 1920 to 2008 across bonds of various different ratings after 1 year, 5 years, 10 years, and 20 years. So each of these years, each of these rating categories has 4 different bars, each of which corresponds to a different number of years since the bond was issued. And so let me just show you what one of these numbers is. So this green little bar right here is 0.9%. What this means is that 10 years after a AAA bond has been issued, the default rate of those bonds is 9/10 of 1%. So 9/10 of 1% of all bonds issued as AAA, after you wait 10 years, some of them are going to default, it's going to be 90 basis points. That's the default rate historically, if you wait 10 years. On the other hand, if you look at this category, single BA category, this BA category says that after you wait 10 years, 18.4% of bonds rated BA will default. So if I asked you to rate the blue bonds based upon these numbers, how would you rate the blue bonds? 1% default rate for the blue bonds. Where would it go in this category? AAA, exactly. If I now asked you to rate the orange bond, where would that go? BA, exactly. And that's exactly what happened. The rating agencies did the math, got the transparency from the issuers, and said, I'm going to rate you blue bond AAA, I'm going to rate you orange bond BA, and by the way, BA is below investment grade, which means that pension funds, money market funds, commercial banks, and other financial institutions that are fiduciaries are not allowed to invest in them. Who invests in them? Those are the hedge funds. They can invest in them. Now, even with a AAA rating, there are certain financial institutions that still won't touch them, like a money market fund, where a money market fund really wants to make sure that there's just no chance of a loss. So the marketing geniuses that issued this paper, they came up with the idea. They said, you money market funds and banks and other conservative institutions, we know that you're concerned about principal risk. So what we're going to do is one better than going AAA. What we're going to do is we're going to buy insurance on the principal for you at our expense. And the insurance will guarantee that in the unlikely 1% chance that we default, the insurance company will pay you the principal so that you can be assured that there's no principal risk. So this tranche we're going to call super senior. It's going to be even better than AAA because we're going to layer on top of it insurance. And we're going to pay for that insurance. And we're going to make sure that that insurance is so reliable, we're going to go to the very best insurers, the very highest rated insurers. How about, I don't know, maybe AIG, AAA rating. So they did that. They bought insurance and created super senior tranches and sold a ton of this paper. And the BA paper, that was the residual, that got sold as well to hedge funds. And why were hedge funds interested in this piece of paper? Anybody give me the basics of that calculus? At $810, is that a good bet? Is that a good deal? Why would hedge funds want that? At the risk of stating the obvious, if that bond does pay off, you're looking at 20% rate of return. And hedge funds are incentivized to take risk for their investors, and they will get paid a percentage of that upside. So at $810, there is a lot of upside. There's a lot of risk, but there's a lot of upside as well. So a lot of this paper was issued. How much was issued? Well, let me give you an idea just to get a sense of the size of this market. In 1996, if you take a look at the total amount of mortgage-related debt that was issued that 1 year, that was about $480 billion. That was just for the United States, right? Just 7 years later, from 1996, we fast forward to 2003. 7 years later, that number goes from 480 billion to about $3 trillion. $3 trillion in 1 year. That's how much mortgage-related debt was issued. And that's one of the reasons why when Paul Krugman was asked around that time, how do you characterize the US economy? He said, oh, it's very simple. We buy and sell homes using money borrowed from the Chinese. That's our business. And he's not far wrong, at least not in the heyday of these markets. It's because these pieces of paper were structured to be incredibly attractive to a large group. Yes, Sean?
The fundamental assumption is 90% of 10% of default rate. And I'm just wondering whether all the share stakeholders agree with that fundamental assumption, like 90% of not default.
Well, certainly there was a lot of there are a lot of different models that are made to estimate different default rates across different securities. So there's definitely room for differences of opinion, and that's part of the reason why this market was so attractive. But in addition to the differences of opinion, there's also the fact that different stakeholders had different risk aversion parameters. They had different willingness to take on risk. So you and I can agree on the risk, but disagree on whether or not we're interested in buying it. The fact is that because we created all of these different tranches, we now had lots of different products to sell to different clientele. So I would argue that it's not so much differences of opinion in the default rates as it was just the different levels of risk that we might agree on, but what we disagree on is the willingness to take on that risk. So getting back to the housing market, what do you think happened? With all of this financial innovation and these pieces of paper floating around, not surprisingly, the housing market there was a boom that was created in this housing market. And let me show you what that looks like. So this is the Shiller Index of US residential real estate from 1890 to 2006. And this index is a real index, meaning it takes into account inflation, so I can compare apples to apple across time. And first, let me show you what the population growth was over the course of the last century or so. Clearly, the US population has grown quite a bit, so housing has become more important in this country. And you would expect the index might rise a bit over the course of that time period. So let me show you what that index looks like. Here it is. This is from 1890 to the peak of the housing market in 2006. Anybody notice anything slightly unusual about this graph? You don't need a lot of machine learning to identify the fact that the 10-year period from 1995 to 2006, there was a nearly doubling of US residential real estate. How many people actually transacted a home during that period of time, by a show of hands? Anybody? Yeah, so you were probably pretty happy campers during that period, weren't you? Because home prices just kept going up year after year. And you know what? If you can't afford to buy a home, don't worry. Get a mortgage and buy it anyway and wait 3 years and refinance. That's what you were told. And in this kind of a market, that was actually pretty good advice. So the problem, of course, is that it didn't last. And in 2008, The Economist published an article by the chief risk officer of a commercial bank that described the experience. And let me just read to you very quickly what he experienced, because I think you'll see where we're going with this. In May of 2005, we held AAA tranches, expecting them to rise in value, and sold non-investment grade tranches, expecting them to go down. From a risk management point of view, this was perfect to have a long position in the low risk asset and a short position in the higher risk asset. But the reverse happened of what we had expected. AAA tranches went down and the non-investment grade tranches went up, resulting in losses as we marked the positions to market. This was entirely counterintuitive. Explanations of why this had happened were confusing and focused on complicated cross-correlation between tranches. In essence, it turned out that there had been a short squeeze in non-investment grade tranches, driving their prices up, and general selling of all the more senior structured tranches, even the very best AAA ones. Yeah.
Yeah, I mean, this must be a really bad risk manager. I mean, there is not that much counterintuitive. If you introduce some kind of correlation between the two bonds you had, you will definitely have that the junior tranche is much more.
Exactly right. So you could argue that this is a really bad risk manager, but I'd like to take his side for a moment and argue the case that unless you actually actively modeled the correlations, you would not have seen this. And let me show you. So this sounds confusing, right? In 3 minutes, all of you are going to understand exactly what Ivan and the rest of us now understand.